Hello, it's Robert Miner with Dynamic Traders Group with some trade strategies for the week beginning September 14th, where we do a very brief video. We highlight 2 or 3 potential trades coming up in the upcoming week. And it's similar to the video we do for our DT Reports subscribers, which of course is much more extensive than what we do for our YouTube and Twitter and Traders News subscribers, but you should get a taste of what we do, and if you like what you learn, check out my book, High Probability Trading Strategies, or check out a DT report where you can get a 1-month trial for just $19. So check both of those out if you think you're learning something. Okay, let's get started. Take a look at a couple markets. The first market we're going to take a look at is soybeans. I realize probably most of you that are listening to this don't trade any of the agricultural markets, but it's just bars on a chart. So what you learn from this situation, you can apply to any of the financial markets as well. And by the way, you might consider tracking 1 or 2 of the agricultural markets, a little lower margin, and when they trend, they really trend, and they stay with those trends frequently for many weeks, if not months. This is soybeans. It's a daily chart of the November contract, and there's a great lesson to be learned here that's applied to any market and any time frame that you trade. The middle of last week, around Wednesday, I did a chart and just put it up on Twitter that we had reached what would be the typical end of wave 5 target. Now that's a Elliott wave term, end of wave 5. We had pretty obvious 1, 2, 3, 4 coming up. If that's the case, notice my language, if this is a wave 4, then we would probably continue to a new high to complete a wave 5. And as of Wednesday, we're right in the high probability zone to complete a wave 5. Just one of the price relationships there was the 162% external retracement of wave 4. I don't have all the others on it. So what's important is that if you reach a price zone that's support or resistance from however you calculate that, whether you use end of wave price targets like we do when there is an obvious wave count or just simple retracements, that type of thing, is that you don't automatically go long or short. Then you devise a specific strategy that the market has to trigger a reversal and then confirm that reversal before you actually enter the trade and decide that it's probably making a reversal of whatever degree you're looking at. So here we were as of Thursday, and so this is one of the updates I gave subscribers. It was a very narrow day, but we did close lower on the day, and we had a slightly higher high by a tick or two on the day, but very narrow days. So the strategy, that's a reversal signal, and it's a reversal signal with daily momentums overbought right from the end of wave 5 target zone. So the strategy was for the following day before considering executing a short trade is, one, the following day we'd have to trade below the low of Thursday and then make a lower close. In other words, we would have to have 2 consecutive lower closes before we would consider that the end of wave 5 was complete. And of course, as we know, that didn't happen. So it didn't trigger a go short or even an exit from if you happen to be long. So what's happened here as of the end of the week and Friday, big 18-cent up day. So then if we've gone past the typical end of wave 5 target zone, let's figure out what's about the maximum if indeed this is a 5-wave advance. So first, let's go to the higher time frame. This is the weekly data coming, we're up from the early January, which was significant. And of course, we exceeded that this past week, a really wide range week this past week, closing near the high. Now, a lot of people look at that and say we just made a breakout into a new high. That's a trend continuation signal. And yes, it can be. It depends on where a market is with the other technicals. So let's just take a look at a couple of things here. We'll start with the price. What's this 162% alternate price projection? Well, that's the range of what I have labeled as a wave 1 array from the April low into the July high times 162% from this corrective low in August. Now, that's a real typical end of wave 3 target zone and a maximum for a wave C. So if we're looking at this as a 1 or A, this is a 2 or B correction. Boy, if you're into Elliott wave and you're just familiar with the the basics of Elliott wave, and everybody should be. It's really simple stuff. You can learn everything you need to know about Elliott wave in about an hour and a half. But that's a real typical target for a wave 3, and of course we just came up and tagged that on Friday. We'll see some other relationships on the daily chart, but our weekly momentums are dual look back overbought. So we're kind of near a technical extreme and a price extreme and a pattern extreme, as well as a time extreme, to complete a weekly high, even though we just now made this break above. So it depends on the other time, price, pattern, and technical positions when a market makes a breakout on whether it's likely to continue or not. Also, if we go all the way back to the January high, approximately every 4 or 5 weeks, we make a weekly reversal that lasts a few weeks. So last week was week number 4 from the low in August. So if this 4 to 5 week reversal pattern continues, that would indicate next week is probably the maximum before we complete a weekly high. And then we have some sort of correction similar in time and price to what I got labeled as a wave 2 or B. So we're on alert that we're near a top. So let's go back to the daily again. We shot right through the typical end of wave 5 price target. Here's that 162% alternate price projection of the range of wave 1 or A. And then above the market, around 10.05 up to 10.08, are two really important price relationships related to these swings on the way up from the wave 2 or B August low. And one is the 62% alternate price projection of the net range of waves 1 through 3 from the wave 4 low. The end of wave 5 is frequently around either the 38.2% or the 62% alternate price projection of the net range of 1 through 3. And just above that is the 100% alternate price projection of this wave, what I got labeled a wave 3. And that, again, is typically a maximum on the upside. So we've got a fairly broad range, 997 to 1008. Let's just round it up to 1009 as a very high probability maximum on the upside. And Tuesday, look at this. We've got 10 days from the last high, 10 days. 10 days, 10 days, 10 days. Friday was day number 8. So if this 10-day daily cycle continues, that would be, Tuesday would be the ideal day to complete the next daily high. And because next week is week 5 on the upside, and typically the maximum on a weekly count, we have daily time factors and weekly time factors early next week, as well as we're in the price zone to complete the high. Again, we don't go short or we don't exit our longs just because we've reached those time and price targets for this potential 5-wave advance, but we're aware of that. We're aware that the weekly momentums are dual look back overbought. We're aware that the daily have been dual look back overbought for this entire 5th wave, and because of it slowed down the momentum advance these past few days, it actually has made a bear reversal, even though we had a big up day on Friday. We want to be aware of all that. We're near all those extremes, and let's just say early in the week we make a reversal day, which is a new high on the daily data, but we close below the close of the prior day. That's a reversal day that's made at the extremes of time price pattern to complete the higher time frame weekly high, but then we want to follow through. We want at least some minor signal that that's a significant or a valid reversal day, and that the market then is actually reversing by having some follow through. Frequently, we look for the second lower close. That's a good minor confirmation signal the top's been made. So if you're interested in soybeans and you got a position in soybeans, don't get overly excited because we've broken out to a new high above last January high, and we had an 18-cent uptick on Friday. Be aware that we're near the extremes, and you want to be trailing the stop pretty close to the market. We're probably very close to completing a weekly high by early or the middle of this coming week. So let's take a quick look at gold just because we looked at it last week. This is the weekly data. What's significant this past week is gold on its DT oscillator made a bull reversal on the 8 look back from the oversold zone. That's usually a real good setup that we've completed a weekly low, or we're within 1 or 2 bars, in other words, 1 or 2 weeks of that weekly low. So we're getting really close, and because we made that bull reversal, we want to then identify a specific trade plan. So we go to the daily data, and what happened this past week is we made a daily momentum bull reversal back on Tuesday, both a price reversal and a momentum bull reversal without having closed below the last swing closing low. So that's a setup for a potential completing this correction. So is it complete? Is that a go-long strategy? Well, as of Tuesday, the weekly momentum, because the weekly bar wasn't finished, hadn't made a bull reversal. So then we need a confirmation. Again, reversal, confirmation, reversal, confirmation. And a confirmation would be a close above 1978.90. That's the last closing swing high. Those are closes. And we haven't done that yet. So here's again another setup that we're looking at, not to immediately go long. Number one, we want to be aware we're really close to completing this correction. What follows a correction? A resumption of the trend to a new extreme. That means more than likely when this correction is complete, then gold's going to continue to advance to above the August high. That's why we want to be alert right now. So if gold were to make, and this is the December contract, a daily momentum bear reversal without having closed above 1978.90, good possibility that it's going to continue down to a new low, and this indeed will have been an A, B, C, B, and then we're going to finish off a wave C within the next week or two. So again, it's trade strategies what are key, not forecasting. We want to identify key time and price relationships related to the pattern and the symmetry in the market, and then understand why and under what conditions those price relationships are important. So what happens if before we make the daily momentum bear reversal, gold were to close above 1978.90? In that case, more than likely, this wave 4 is complete, and it turns out that it's an A, B, C, D, E wave 4. We wouldn't immediately go long in a close after above 1970.90. Why? Because our momentums are already near the overbought zone, so we're very close to completing a daily high. We'd wait for the next cycle and bull reversal in the momentum. Momentum cycles are really important. So it's the trade strategy that's the key to understanding the probable position of the market and identifying a trade setup where you can take a specific trade at a specific price at a specific stop loss that has acceptable capital exposure and a very high probability based on a number of technical factors of continuing the trend and confirming the reversal. So that's it for today. Again, our DT reports aren't forecasting reports. We identify trade opportunities, and we teach you every week about trade strategies. That's it for today. Robert Miner over and out. Take care.